Chapter 11, Investment Planning. And the learning objectives are to discuss the role that investing plays in the personal financial planning process and identify several different investment objectives. Distinguish between primary and secondary markets as well as between broker and dealer markets. Explain the process of buying and selling securities and recognize different types of orders. Develop an appreciation of how various forms of investment information can lead to better investing skills and returns. Gain a basic understanding of growing impact of the computer and the internet on the field of investment, and describe an investment portfolio and how you go about developing, monitoring, and managing a portfolio of securities. That's it for me. Investing is the means by which many important financial goals in life are achieved. This chapter discusses how to determine the amount of capital needed to reach goals, how to buy and sell investments, the market context in which investing occurs, how to evaluate investments, sources of investment information are discussed. After reading this chapter, you should be able to plan your investments to better meet your financial goals. Okay, one thing I will say real quick about that, as far as analyzing, if we go to CNBC, and I know Devon is a huge company here in Oklahoma, and if we look at Devon here, there it is. Okay, so if we look at Devon Energy, and we see, let's look at a 5-year chart. Okay, so you can see in a 5-year chart, here we are today at $10, right? Closed at 10.44, and back here we were at $50. Okay, so you would only have about, if you invested back here, you'd only have about 20% of your original investment today. And one of the things you can see is looking at the debt to equity. That means they owe 140% of what they actually have in equity. So they actually owe 40% more than they're worth as far as equity is concerned. And net margin, negative 40%. That means they're losing 40% on everything they sell. So if it costs them, if they're buying, if they're selling something for $1, it costs them $1.40 to actually produce and get it to market. The other thing that I would look at, if I can find it here real quick, or maybe I can't. The PE is, there it is, this one, beta. The beta is what I was looking for. 3.33. Anything over a 1.0 is considered risky. The higher you get away from 1.0, the riskier it gets. Okay? So the beta is 3.33, so this is an extraordinarily risky stock. And that shows that, and it shows because you've lost, 80% of its value from 2017 to today. So in 3 years, it's lost 80% of its value. Okay, if we look at another popular stock, go to Apple. Okay, so 5 years on Apple. You can see today, or I should say Friday's close was at $498.95. The close is $497.48. After hours, it went up another $1.47 to $498. You can see the chart. I mean, my gosh, look at that. If you'd have bought it back at the same time as the Devon deal back here in 2017, you'd have paid $119 for it, and now it's worth $500, rounding. So more than 4 times your investment you'd have gotten. So you would have earned $380 just about per share in profit on every share that you purchased. Huge difference from Devon. Go down here. The beta, see, it's a little bit riskier. It's 1.23, so it's a little bit riskier than the 1.0. but it's pretty close to 1.0. So your risk isn't that high. Again, compared to Devon at 3.33. Its net margin is 21.33%. That means it makes a profit of 21% on everything it sells. The net profit, net margin. Gross margin is 38%. So that means for everything it sells, let's say for every $100 product it sells, $38 is a gross profit of that. So that's very profitable, comparatively speaking. And what was the other one? Oh yes, the market cap. $2,127,000,000,000. This is the most valuable company, publicly traded company in the United States. First one to ever break the $2 trillion mark. Okay. So it's the opposite of Devon at this point. Okay. So going back to what we were talking about. Objectives of rewards of investing. Investing in the process of placing money in some medium such as stocks or bonds in the expectations of receiving some future benefit. Speculating, a form of investing in which future value and expected returns are highly uncertain. So that would be a Devon. So if you want to put something that's very risky, you would buy a Devon stock because that's extremely risky. If you're risk averse, then you would go more towards of an Apple stock because the beta is near 0. Or you'd find a stock that the beta is near 1, Or you'd find a stock that where the beta is below 1, so it's very risk averse. Okay, and then go from there. There it is. How do I get started? Regular allocation of earnings for investing. Build a pool of investment capital. You could invest through Robinhood if you want to go in the stock market, or Charles Schwab. There's several other ones for E-Trade or something like that are very inexpensive if you wanted to buy stocks or bonds over the internet. Building capital. How much money will it take to get started? You can start as little as $500 really and buy stock or bonds. You can do the future value. Of course, 9% is outrageous in today's world, unless you're doing a very, very risky investment. As far as returns, okay, rates of return. Yeah, see, these are extreme. These numbers are so out of date; they don't apply anymore. Okay, let's go down to here. Different ways to invest. Multiple ways: common stock, bonds, preferred stock, convertible bonds, mutual funds, exchange trades, funds, notes, and real estate, just to name a few. Common stocks, that's what I just showed you with Devon and Apple. Bonds, you can do corporate bonds, you can do municipal bonds, which are called muni bonds. Those are you buy bonds from municipalities and they use it to repair roads or build schools or something like that. And you can then get a return on your investment that's predetermined. And most of those are fairly safe. There have been several bankruptcies in the past couple of years of municipal bonds, which means you lost all that you invested. But for the most part, they're fairly safe. Although with COVID-19, that might not be the case anymore because a lot of municipalities, a lot of states are near bankruptcy. And we talked about that, I believe, in class, how Oklahoma based their budget this year on oil being $54 a barrel, and it hasn't gotten much higher than $41 a barrel and was as low as $12 a barrel back in May. So their revenue is very low, and so that's becomes a very high risk. Much more likely that they'll not pay their bonds if they don't have the money to do so. Okay. Preferred stocks have a stated fixed dividend rate that must be paid before any common stock dividend is paid. That doesn't mean it has to be paid, though. If they can't, if they don't have the money to pay it, then they just won't pay any dividends. So it's not guaranteed that it's going to be paid. Okay, mutual funds, a professionally managed portfolio of stocks, bonds, and other investments. Return varies based upon the market and the type of investment selected by the manager. ETFs or exchange traded funds designed to track a basket of indexes of equities. They may be traded through the day. Exchange traded funds, ETN, exchange traded notes, senior unsecured, unsubordinated debt securities. Okay, so these are all different ways, all different things that you can invest in. Some are riskier than others. After the crash of 2008, a lot of people that thought they were investing in safe ETFs found out that they were not so safe and they were basically worthless. And that's was the collapse of the market. Real estate investments range from raw land speculation to limited partnerships in commercial properties to common stock in real estate corporations or builders like D.R. Horton or something like that. You can invest in the builders themselves. You could also invest in what's called a REIT, a real estate investment trust, and that money is used for commercial development, and then the rents that are collected on it are then paid back as dividends. Securities markets where financial instruments are traded, capital market long-term securities, money market low-risk short-term securities that pay almost nothing in return. We're talking less than 1%. Primary markets, new issues available for the first time. That would be your IPO initial offer. Secondary market, previously issued securities. So everything you see on the stock market, that's secondary market. The primary market would be the initial public offering. That's what IPO stands for, initial public offering. And that's the only time that the company itself gets the money. So if you owned a corporation and you wanted to sell stock in it on the publicly traded market, you could do an IPO, and then whatever stock you sell, that money comes back to the company, and then every time that stock sells again, it's just traded between two people. It's like a used car. It just goes from one party to the other, and the actual manufacturer of the car doesn't get a dime after it's been sold for the first time. So the same happens with stocks. It only goes back to the original company once when it's initially traded, the IPO. Every time after that, it's just two parties exchanging money for the stock. And that's called the secondary market. Broker-dealer market, buyer and seller come together. Direct trade takes place between the two of them. Dealer market, buyer and seller never meet. Okay? Buyer, seller, orders executed separately through security dealers acting as a market. So the dealer market would be like the stock market, because you never meet the seller or you never meet the buyer. You just put the order in to either buy or sell something, and then it's executed, and you never meet the other party. Okay, last one is this little model that shows the brokers, regional exchanges, national exchanges, dealer markets, NASDAQ and the OTC, and then goes up into the secondary market. Okay? So this market, broker-dealer market model shows you the differences between the broker market and the dealer market. And that's all we have time for this chapter.